Source code speaking. The Asian guy TAG here. Markets open in 4 hours. Not tomorrow, not next week, 4 hours. And if you are watching this right now, you already know that something has shifted. The weekend was not quiet. The weekend was a pressure cooker. Silver, gold, oil. A war that is no longer a headline. It is now a market structure event. We go through all of it. Numbers first, context second, and then you decide what to do with the information. Starting with silver. Western spot closed Friday at $81 flat. Shanghai physical is pricing at $93. So that is a $12 gap that is not closed. That gap is not a glitch. That gap is the market telling you something in two different languages. One language is paper, one language is physical. They are no longer saying the same thing. COMEX total silver inventory sits at 346 million ounces as of Friday's close. That number dropped 3.1 million ounces in a single session Thursday. 3.1 million ounces in one day. 9 consecutive weeks of net outflows from registered vaults. Not eligible, registered. Metal that is ready for delivery. When that number drains, the mechanism that keeps paper prices anchored to paper promises starts showing cracks. LBMA London silver inventory dropped 2.4% in February alone, now sitting at 868 million ounces. Both the Eastern and Western vault systems are losing metal simultaneously. The paper market is quoting $81. Shanghai is paying $93. The vaults are draining. 3 separate signals. One direction. That is not sentiment. That is mechanics. The $12 premium is not noise. Premium compression happens when supply is ample. Premium expansion happens when physical demand exceeds what paper markets can deliver. Right now, physical demand from Asia is running hotter than the paper system was designed to handle. You can manufacture a paper price. You cannot manufacture physical ounces in a vault that is already emptying. That is not a theory. That is arithmetic. COMEX silver open interest as of Thursday stood at 140,800 contracts. Each contract represents 5,000 ounces. That is 714 million ounces of paper silver, against 346 million ounces in total inventory. The ratio tells you everything. For every ounce sitting in a COMEX vault, there are 2 paper claims standing against it. And when physical drain accelerates, those claims do not disappear. They compress into a smaller and smaller pool of deliverable metal. That compression is a setup, not a prediction. The mechanism is already in motion. Now gold. Western spot closed Friday at $5,171. PAX. Gold on weekend markets is pricing at $5,178, essentially flat from Friday's session. Kinesis Gold is trading at $5,174. The weekend signal for gold is not screaming a directional move, but do not read flat as calm. Flat heading into a Monday with active oil infrastructure destroyed, a supreme leader transition underway in Iran, and 3 of the world's largest private credit funds simultaneously blocking redemptions. Flat is not neutral. Flat is the market holding its breath. Gold closed above $5,170 for the 4th consecutive session. The tape objectives we tracked Friday sat at $5,181 and then $5,200. Those remain in play. Friday's 8 a.m. lows are the invalidation level. If Monday opens and gold does not violate those morning lows, the structure is intact and the tape is still reading toward those higher targets. Gold was the stronger of the 2 metals on Friday. That relative strength matters. When gold leads silver to the upside, historically, the move is institutional, not speculative. Institutions do not chase momentum. They position ahead of it. GLD, the largest paper gold ETF, just recorded one of the largest weekly outflows in the past 3 years. $4.2 billion left GLD in a single week at near all-time high prices. Someone with significant size is selling the paper instrument. But the physical price is not following that selling. Gold remains above $5,170 despite that volume of paper hitting the tape. When paper sellers cannot move the price down despite record-selling pressure, the structure underneath is not fragile. It is anchored. That divergence is not background noise. That divergence is the signal. The resistance case always has 2 sides. Paper markets still dominate short-term price discovery. A ceasefire rumor, a DXY spike, or coordinated algorithmic selling can flush silver and gold fast. Physical tightness means nothing to an algorithm running a stop hunt. $93 Shanghai premiums do not protect a long position from a Monday open gap. Down if macro data prints wrong. The data calendar this week is loaded. CPI Wednesday, GDP, PCE, and JOLTS all hitting Friday. Any one of those prints landing in the wrong direction gives paper sellers exactly the window they need. Respect that short-term volatility is real. It does not care about your thesis. Position accordingly. Now, the broader picture. Because what happened this weekend is not a single event. It is a sequence. And sequences have momentum. U.S. and Israeli forces conducted coordinated strikes on major Iranian oil infrastructure overnight Saturday. Fires burned through Sunday morning across Tehran's southern districts. Oil spilled from storage depots into drainage systems, caught flame on highways, and by dawn, residents across 3 neighborhoods woke to a skyline covered in black smoke. That is not a skirmish. That is infrastructure warfare at scale. Iraq's oil production has collapsed by roughly 58% as the conflict blocks tanker movement through the northern Persian Gulf corridor. On Hyperliquid, the decentralized futures platform that does not close when CME does, U.S. oil printed a high of $127 overnight before settling back to $115 at the time of recording. Brent touched $98 on the same platform. These are directional signals, not guaranteed Monday opens. But when a market that never sleeps is pricing oil at $150 on a Sunday, the regulated market that opens tonight is not going to open in a vacuum. It is going to open with full awareness of what the 24-hour market already processed. The oil infrastructure is not the only target. Reports now indicate U.S. and Israeli special operations units are in planning stages for a ground incursion into Iranian territory with a specific objective: seizing Iran's nuclear stockpile, approximately 450 kilograms of highly enriched uranium, enough fissile material for roughly 10 nuclear weapons. If that operation moves forward, a ground incursion into Iranian sovereign territory is no longer a contingency scenario. It becomes a stated military objective. That changes the duration calculus of this conflict entirely. This is no longer a strike campaign. This is a structural confrontation with no defined exit architecture. Let me be precise about what hyperliquid prices mean. They are directional signals, not guarantees. The supply disruption is real, the infrastructure damage is real, the war is real. None of that means you press every available button the second CME opens tonight. Markets have a very specific way of punishing the obvious trade. And right now, nothing is more obvious than oil going higher. If you are trading this open, that decision is yours. This channel is financial warfare education, not a signal service. Use the weekend crude print as context, not as a trigger. The Strait of Hormuz remains the central pressure point in this entire energy equation. Roughly 20% of global oil flows pass through that single choke point. Every supertanker navigating that passage is now operating inside an active conflict zone. Iran struck a desalination plant in Bahrain over the weekend. That detail matters far beyond the headline. Kuwait draws over 90% of its fresh water from desalination. Qatar sits near 100%. UAE and Saudi Arabia both above 70%. When water infrastructure becomes a battlefield target, the escalation calculus shifts from military exchange to civilizational pressure. Iran's foreign minister issued a formal warning that attacking critical infrastructure carries grave consequences, then proved the warning was not rhetorical by hitting Bahrain's water supply within 36 hours of the statement. The conflict has moved past missiles and military installations. It is now infrastructure warfare across the Gulf coastline directly facing Iran across the Persian Gulf. Once energy systems, water systems, and shipping lanes all become simultaneous targets, the region does not price as a conflict zone. It prices as a systemic risk zone. And when markets price systemic risk, they stop calculating supply and demand variables. They start pricing geopolitical survival. That is a different equation entirely. Saudi Aramco surged by its largest single session move since April 2023 on Sunday. The story underneath that price move is larger than a stock chart. Aramco fields came under drone attack this weekend, with confirmed damage reported at the Abqaiq processing site and the Ras Tanura refinery, Saudi Arabia's largest export terminal. The facility was forced to partially halt operations following last week's strike. Aramco is now actively rerouting shipments through Red Sea facilities on Saudi Arabia's west coast to bypass the strait entirely. 8 supertankers are already loaded this month on pace for a monthly record. Aramco also raised its April oil price for Asian buyers by the largest increment since August 2022. Earnings call is March 10th. That number is going to reflect a company operating inside a war. South Korea is formally weighing an oil price cap for the first time since 1997. The last time energy markets looked like this, people called it the 1970s. Supply shock, stagflation, inflation that rate policy could not touch, dollar credibility under sustained structural pressure. If you know what gold and silver did during that decade, you already know what this precedent means. The 1970s were not a short-term event. They were a structural realignment that lasted an entire decade and permanently repriced hard assets against fiat currency. The setup today has structural similarities that are worth sitting with seriously. Higher oil prices hit manufacturing economies harder than energy-producing ones. China is particularly exposed. Higher import bills, smaller trade surplus, fewer export dollars. And because oil is priced in dollars, every importing nation must first acquire dollars to purchase energy. That is not an accident of history. That is architecture. Gold becomes critical in this framework because a structurally higher gold price strengthens sovereign balance sheets in an over-leveraged world. When energy costs rise and currency credibility falls, the sovereign that holds gold is better positioned than the sovereign that holds paper reserves. Energy, gold, and geopolitics are not separate stories right now. They are the same story being told in different asset classes simultaneously. Trump stated publicly over the weekend that the war will continue for a little while. He declined to project a timeline when pressed by reporters and responded with 3 words: whatever it takes. That is not a de-escalation message. That is a war economy message. The U.S. has spent approximately $6 billion in the first week of active operations alone. $4 billion of that figure allocated directly to munitions, mostly missile interceptors and precision strike systems. That spending rate is not just a number about intensity, it is a data point about duration. Governments do not build out munitions procurement pipelines for short campaigns. They build them for extended ones. The financial architecture of this conflict is already signaling what the diplomatic language is not yet admitting. This is not a weekend operation. This is a sustained engagement with an open-ended timeline and a defense budget being rewritten in real time. Iran has selected a new supreme leader, and an announcement is expected within days. Israel immediately issued a formal statement that it will target every new leadership figure Iran appoints. Iran responded by declaring it is fully prepared for full-scale war. These are not statements that leave room for back channels. These are statements of entrenchment. When both sides publicly eliminate the possibility of a negotiated leadership transition, the conflict is no longer operating inside a diplomatic framework. It has moved entirely into a military one. The language of de-escalation requires both parties to believe de-escalation is possible. Neither party is currently signaling that belief. China stepped formally into the frame over the weekend. Foreign Minister Wang Yi, speaking at the National People's Congress session in Beijing, stated that China stands ready to restore order, tranquility, and peace to the Middle East. Read that language carefully. China did not say it wants peace. It said it stands ready to restore it. That phrasing is not diplomatic courtesy. That is positioning. Beijing is signaling strategic interest in the regional architecture at the exact moment the existing architecture is under maximum stress. Iran is a key node in China's Belt and Road infrastructure. Middle Eastern oil flows primarily eastward. China's calculated positioning here is not neutrality, it is preparation. Now, the risk asset picture, because it connects directly to where capital is moving right now. Over $190 billion was wiped from the total crypto market cap in 3 days. Bitcoin fell over 8%. Ethereum dropped nearly 10%. That was on top of Friday's existing losses. The S&P 500, NASDAQ, Dow, and DAX all closed lower on Friday. Over $900 billion erased from U.S. equities in a single session. Risk assets across the board are not pricing a short conflict with a clean resolution. They are pricing a prolonged engagement with unknown duration and compounding macro consequences. That is not fear, that is the market doing math. Now, private credit, because this piece of the picture is not getting enough attention, and it should be. BlackRock just moved to limit withdrawals from its $26 billion HPS corporate lending fund after receiving $1.2 billion in withdrawal requests in a single quarter. They capped redemptions at 5% and blocked the remainder. Blackstone's $82 billion private credit fund hit record withdrawal requests in the same week and had to inject $400 million of its own capital just to cover investor exits. At Blue Owl, investors pulled 15.4% out of one fund in January alone, forcing the firm to sell $1.4 billion in loans to fund payouts. The fund then permanently halted traditional redemptions. 3 of the largest alternative asset managers in the world. Same window, all hitting the same wall. Howard Marks wrote that market cycles turn at the point of maximum complacency, when the risks feel most remote. 18 months ago, nobody was pricing private credit illiquidity as a systemic concern. Today, 3 major funds are blocking exits in the same week. The cycle does not send a formal announcement. It just starts closing doors. And when the doors close simultaneously across institutions of this size, the capital that was sitting in private credit has to find somewhere else to go. Some of that capital moves to cash. Some of it moves to gold. The historical pattern during private credit stress events consistently shows institutional allocation rotating toward hard assets. Watch that rotation. It is already beginning. Now gold again, because the mainstream framing is getting this completely wrong. GLD recorded one of its largest weekly outflows in recent years. $4.2 billion left the paper gold instrument in a single week at near all-time high prices. The surface read is that institutions are selling gold. The accurate read is that institutions are selling the paper wrapper around gold. They're redeeming ETF shares, and in many documented cases, taking physical delivery instead of cash. The paper is leaving, the physical is not. Gold is still trading above $570 with that volume of selling pressure hitting the tape. When paper sellers of that magnitude cannot push the physical price down despite record outflow activity, the structure underneath is not showing weakness. It is showing remarkable resilience. that resilience is the signal, not the outflow number. Physical gold demand from central banks in 2025 has already matched the full-year pace of 2024 through February alone. The buyers are not retail. The buyers are sovereign. Poland, Turkey, India, and China have all reported accelerated purchases through Q1. When sovereigns are buying physical at this pace, while paper ETF holders are selling paper instruments, you are watching two completely different markets operate under the same price ticker. One market is pricing a trade. The other market is pricing a decade. The week ahead carries specific catalysts that cannot be ignored. CPI data, Wednesday, GDP, PCE, and JOLTS all dropping Friday. Each one of those prints carries the ability